Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings and reveal the hidden stories within the numbers, especially when they involve some unexpected accounting adjustments. Today we are dissecting American Resources Corporation's latest filing. This is not just any financial report, it's an amendment to an amendment, which means we are digging deep into some eye-popping corrections and restatements. Get ready for a ride because this company has been through a lot and their numbers tell a wild story. If you appreciate getting straight insights from corporate documents, make sure you are subscribed and check out our Discord community linked in the description below. So here we are with American Resources Corporation's amended annual report. It is an amended report because they are cleaning up past financial statements and adding new information after an CAC comment letter. They're telling us straight up that the financial disclosures have been revised and they are correcting errors and restating certain items presented in both their 2024 and 23 financial statements. This is where things get interesting. Let's talk about some of these corrections. They found an error in their depreciation expense calculations for a quarter in 2024, leading to an overstatement of depreciation and amortization of mining rights. This meant their accumulated depreciation as of the end of 2024 was overstated by over $850,000. That is a significant chunk of change that was simply miscalculated. Then there is the 2023 Statement of Operations. They missed some crucial revenue adjustments, increasing costs and decreasing sales by over $1.4 million. The good news is they say this did not change their overall net loss for 2023, but it is still a pretty big number to miss in the first place. And get this, some money that was labeled as restricted cash on their balance sheets for both 2024 and 2023 should have been classified as restricted investments. They are essentially moving money around on paper between different types of holding accounts. This looks like a classification error, and they had to fix it for both years. Now let's look at how the company's stock has been performing and who owns it. Their class of common stock trades on the Nasdaq Capital Market under the ticker symbol ARIC. The report notes that their common stock has been thinly traded, meaning it is not bought and sold a lot by big players. As of the end of 2024, they had about 131 shareholders of record with over 77 million shares outstanding. But here is a twist. One of those positions is at Seed and Company, which is where many brokerage accounts hold their shares. So the real number of individual investors is probably much higher but unknown to the company. This section is the company's own narrative about their financial health. They highlight how their revenue has historically come from selling metallurgical coal, which is used in steelmaking. However, they also point out that due to tough market conditions and pricing, they suspended coal production in 2023. This is a huge strategic shift. Let's dive into the actual numbers for the year ended the 31st of December 2024. Their total revenue was a mere $383,234. Now compare that to the previous year ended the 31st of December 2023 when it was over $11.8 million. That is a massive drop of over 96%. Imagine losing almost all your customers in a single year. This is the real impact of suspending coal operations. Their coal production and holdings costs also dropped significantly from over $7.5 million in 2023 to about $2.5 million in 2024. This makes sense because they are not producing coal anymore. When you stop producing, you stop incurring production costs. However, look at their general and administrative expenses. They soared from about $10.6 million in 2023 to over $21 million in 2024. That is nearly a 97% increase. Even though revenue is down and production costs are down, their overhead expenses nearly doubled. This is a major red flag indicating that their core operations might be dying, but their administrative costs are growing, perhaps to support new ventures or due to increased consulting and affiliate service fees. Then we have their other income and expenses. In 2024, total other expenses were about $7.1 million, a big jump from nearly $2.3 million in expenses in 2023. A big reason for this is a huge increased expense from about $1.9 million to over $8 million. This usually means they've taken on a lot more debt. Looking at cash flow for operating activities, they used over $21 million in 2024 compared to about $19.5 million in 2023. This means that even with the drastic revenue drop from coal, they are still burning through cash at a high rate. Scroll cash provided by financing activities $145,679,343.70. But here is where they are getting their money from. Cash provided by financing activities nearly tripled from about $45 million in 2023 to a staggering $145 million in 2024. It seems they are heavily relying on new debt and equity to stay afloat. This is a classic move for companies transitioning or struggling. They are borrowing or raising money to cover their operational burn. Now, about their liquidity, as of the 31st of December 2024, they had only about $600,000 in cash and a working capital deficit of over $73 million. That is a really tight spot to be in. They are relying on cash on hand and future debt and equity financing. When it comes to their internal controls, they admit their disclosure controls and procedures are not effective. The main reason is a lack of staff to perform accounting and reporting functions, properly leading to insufficient reviews. This means there is a real risk of material misstatements in their financial reports going undetected. It is like they do not have enough people to check their own work. The auditors are here to give their opinion. They state the financial statements present fairly in all material respects, but they also highlight a crucial point. They acknowledge that the company has suffered recurring losses from operations, which raises substantial doubt about its ability to continue as a going concern. This is a very serious warning. Basically, the auditors are saying the company might not survive in the long run without significant changes or financial infusions. Let's peek at their balance sheet. Total assets jumped from about $64.7 million in 2023 to over $205 million in 2024. This massive increase is largely driven by a huge spike in restricted investments reaching over $151 million. This suggests they are setting aside a lot of money perhaps to back up new projects or meet bond obligations. On the flip side, their total liabilities also skyrocketed from roughly $109 million to over $286 million. So while they have more assets, much of that is tied up and their liabilities have grown even faster. Their net loss attributable to shareholders paints a dire picture. In 2024, the net loss was over $39 million. This is slightly worse than the over $38 million loss in 2023. Despite their business shift and new ventures, significant losses continue. Looking at their statement of operations reveals the stark contrast. Revenue for 2024 was only $383,234, almost entirely gone compared to over $11.8 million in 2023. But their operating expenses are still massive, over $32 million in 2024, mainly fueled by that soaring general and administrative cost. The company talks about shifting focus to realments and electrified materials. Realments is about rare earth elements and batteries, and electrified materials is about metal recycling. These are industries with high growth potential, but also intense competition and significant development costs. They are essentially betting the farm on these new growth areas to pull them out of their coal business slump. Now, for some legal troubles, they've accrued claims totaling over $2 million from the Kentucky Energy Cabinet and over $680,000 from the Mine Health Safety Administration. There are also notices of intent to place liens for federal excise taxes totaling over $625,000. On top of that, they are involved in a lease dispute where a court entered a summary judgment against them for over $2 million, but they are appealing. Another lease dispute resulted in a judgment against them for over $5.4 million, and then there are other unpaid legal judgments totaling about $3.4 million. They are quite literally fighting fires on multiple legal fronts. Looking at what happened after the 31st of December 2024, there is a lot going on. On the 28th of January 2025, their subsidiary American Infrastructure Corporation was essentially sold in a share exchange deal. Then in February, they distributed about 81% of their ownership in Realment Technologies to shareholders. On the 1st of April 2025, their Kentucky lithium bonds were refinanced with a lower interest rate. They also did some equipment financing and leasing transactions, netting them over $3 million from one deal. And in September, they secured a commitment for a $20 million leasing facility for Realment. They also issued millions of shares of common stock in October through private placements. It is clear they are constantly in transactions trying to manage their finances, restructure, and secure funding. So what does this all mean? American Resources Corporation is in a very precarious position. They are clearly transitioning away from coal and placing all their hopes on new ventures in rare earth elements and metal recycling. Revenue from coal is virtually gone. Their overhead costs are through the roof, and they are burning through cash at an alarming rate. The auditors are warning about their ability to continue as a going concern, which is a major red flag. They are heavily reliant on external financing to survive and fund these new ventures. The financial tables show a massive increase in assets and liabilities, largely due to restricted investments and new bond issuances. The huge increase in general and administrative expenses while revenue is plummeting is particularly concerning. The legal battles are also a significant drain on resources and attention. While the new ventures in rare earths and recycling sound promising in today's market, the execution and the sheer amount of capital required are immense. The company's ability to generate actual profits and manage its growing debt load, while also dealing with ongoing legal issues, will be critical. It is a high-risk, high-reward scenario, and right now the risk factor seems to be exceptionally high. Alright, that is our breakdown of American Resources Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description if you want to connect with us and other keen observers of the corporate world. Thanks for watching, see you next time.